Let's welcome in our next guest, Parag Thakkar, Head of Institutional Sales at HDFC Securities. Parag, good morning. What's the view as far as markets are concerned? Do you think that markets have now started to see some profit booking or some selling coming in? Any bad news and there could be selling pressure now?
Yeah, so valuations no doubt are stretched, at least in the pockets where there is a structural demand story shaping up like paints or cements or so all those are the pockets where valuations have become very aggressive, and wherever there are uncertainties in terms of IT, pharma, there you are seeing very good valuations, but there are some near-term issues over there. So market is clearly polarized within large caps also. And most importantly, I think, so I am not very much worried about Fed rate hikes because that is already discounted in the market. It is a well-known thing that there is going to be a slow and gradual rate hikes. So in any volatility caused due to Fed rate hike fears should be taken as an opportunity to buy long-term structural stories like Maruti or Tata Motors or various other stocks.
As far as the Fed hike or what BOJ will do or what will happen from the ECB side, they are all largely factored into the market, and that's why it may it may not be a very big event, at least in the near term.
So I think a lot of global cues are already known in the market, and for example, Fed rate hike or BOJ, for example, there is an expectation that at some point of time again Japan will do a lot of stimulus in terms of helicopter money and all. So I think global, any Six Sigma event, which is like any big large default somewhere, or that kind of a news, or sudden slowdown in China, that kind of news can only take markets to a very, very lower levels, and then it will be a very cautious thing. You should have a very cautious outlook then. But right now it appears that in near term, those worries are not there. So I would say that any decline, significant decline in the markets due to Fed rate hike worries or some that sort of worries, it should be a good buying opportunity.
Right. What's the sort of level at Nifty where you would think it's a good buying opportunity, say a 5% correction, a 2% correction?
So I would say, it depends on the event, right? The event which brings down Nifty to say below 8500, it can be a Fed rate hike kind of volatility, or it can be a very big event. So if it is Fed rate hike, as I said, then it's a good opportunity to buy. So I would focus more on the event rather than levels.
You said that you would buy structural stories. In terms of large cap, what are the structural stories that you have where valuations are decent?
So I would say that, valuations for every company which has a very good near-term, medium-term and long-term outlook has stretched. So within that pack, I would say Maruti remains the best buy, or Tata Motors remains very good buy. In that pack, where the story is sounding extremely positive from near-term, medium-term and longer-term outlook. And in the contra pack, which I would say value pack, where IT, pharma, telecom kind of sectors have fallen too, there I would see contra opportunities in IT. Because there at least you have excellent balance sheets and managements to back on. So, but there you will have to give time to your investments. But for a long-term investor, any such a sector where the cash flows are so robust, that should be used as a buying opportunity. And during these uncertain times, only the stocks get cheaper.
Let's look at the auto pack which you mentioned. So Maruti versus the Tata Motors. One is trading at an all-time high valuation. The other valuation is around the 10-11 times P. Such a big difference. Then why these two names?
No, see, Maruti is clearly an India story, right? India, we all know the penetration level in cars is so low. Rural India is hardly having some penetration of cars. So there is a huge opportunity to grow. Now with the available, and Maruti has an excellent distribution network in rural India also. So plus there is a shift towards petrol now, which also benefits Maruti. So and if you see in Maruti also, the depreciation number is so high, the cash profits are significant. And if you really see market cap by cash profit, or say price by cash EPS, it is not so expensive still. So in my view, that is the thing, and Maruti is very predictable, while Tata Motors, because of multi-country presence, multi-currency presence, becomes slightly unpredictable. And when there is a global problem, of course, Tata Motors stock comes down. in the anticipation of reduction in demand. So that way I think although Tata Motors is very, very attractive, but Maruti also, given its clear trajectory, deserves a higher multiple.
Do you think the problem with Tata Motors versus a Maruti also is the capex need? Capex need for Maruti is very low. In fact, it's likely to increase dividend payout. And for Tata Motors, time and again when the capex is actually completed, they've announced a fresh new capex.
Absolutely right. So Tata Motors 40,000 crore EBITDA, but capex is also equally high. So that way, yes, your point is valid. That when the cycle is good, they have to keep on investing. So when down cycle comes, actually they don't have that much cash in the balance sheet. So definitely that is a valid point, and that's why Maruti deserves higher P.
As far as two-wheeler pack is concerned, they've done very well, Bajaj and Hero. Would you also look at these names?
So I would be always more bullish on four-wheelers because of the clear under-penetrated category. Two-wheelers I feel is highly penetrated. Of course, with good monsoon, 7th pay commission, everything coming together, I think two-wheelers will do well this year at least. And scooters as a category is doing very well. And there another disruption is HMSI. HMSI is gaining market share.
You mean Honda?
Yeah, Honda. So I feel that I would be more comfortable with four-wheelers than two-wheelers.
But for these two-wheeler names, the sort of innovations that they have lined up, the base effect that is coming in, plus the high cash that they have, don't you think they deserve a buy, or valuations are now not comfortable to buy?
No, I would say that any business where the asset turns are so high, their fixed asset turns in two-wheeler companies are 7-8 times. And plus they do, for example, Hero does 16% margin, Bajaj does 20%. So ROCs are fantastic. So this business definitely deserves the valuation which they are getting right now. The only issue is that I am little bit skeptical about the penetration level. So broader story beyond this year looks little bit hazy in two-wheeler space, while in Maruti it's a clear-cut road for next 5-7 years.
In terms of contra buy, you mentioned IT and telecom. Is telecom a buy, or it's largely something that you would want to track?
No, what I was saying was that amongst the sectors where the valuation have gone into a value zone are these sectors, IT, telecom and pharma. But I would say that in telecom, let us see what happens. Of course, there can be good contra buying opportunities. Let us see what happens in terms of tariff war in data. But the only issue between IT and telecom, which I would say, is IT companies have a lot of cash in the balance sheet, and that gives me a lot of comfort.
What would be your top IT pick, large cap ones?
So I would, HCL Tech is one, because there at least the constant currency growth guidance is 12 to 14%. In Q1 itself it was 6%. So it will be easy for them to meet this guidance. Plus a lot of their business comes from infra management, which is a non-cyclical business and not discretionary. And plus another pick is Persistent, where of course Q2 and Q3 will be relatively soft on the margin front. But from Q4 I expect a lot of traction to start. And they are in right space, cloud, mobile, mobility. So they are rightly placed in the digital space. And now trading at just 13 times FY18 earnings. So I think and very clean balance sheet, clean cash flow generation, good promoters. So, and most importantly, Europe business is just 5% of revenues, and BFSI itself is just 18% of the revenues, which is lowest amongst other IT stocks. So both the problem areas are not there in Persistent. So I would say that in IT stocks, I would go with HCL Tech and Persistent.
As far as, since the last we chat, since what we are seeing now, we've had Infosys talking about slightly lower revenue. Some of the mid-cap companies have issued a profit warning. TCS has also said that, things are not looking as rosy as they were after Q1. Would that change the estimates, or you believe FY17 would be a tough year and focus on numbers beyond FY17?
Yes, so I also feel that FY17 is going to be a tough year, and that is why valuations are where they are. Market doesn't like to see short-term earning downgrades, and that is why, and that is a fear in IT. So, and that is why valuations have become so cheap for such fantastic companies.
as of now, they are not a great dividend yield play as well. I mean, the stock price have not crashed so much that the dividend yield becomes attractive.
Of course, dividend yields are attractive, and I am expecting a lot of buybacks to happen next 1.5 year in IT. Top 5 large IT companies have 1 lakh crore cash. Definitely it will be used, and there are no exciting opportunities to acquire or to grow. So definitely there will be buybacks.
Right. You also look at a lot of mid-cap space. So in the large cap, we focused on auto. Does that mean auto ancillary also becomes a buy?
So auto ancillary I have been very, very bullish on since last 1 year, and I have been recommending stocks like Rane Brakes, Sundaram Fasteners, Carborundum Universal, and various others, Excite for that matter, or Jamna Auto. But right now what I feel is that because the re-rating has happened significantly, for example, 2 of the stocks like Rane Brake and Sundaram Fasteners have virtually doubled in last 2 months. So after such a big and significant re-rating, I would say there will be some consolidation, and market will look forward for triggers like scrapping of older vehicles. If that is delayed, then there can be some consolidation and there can be some price correction also. So rather in mid-cap space, I would tend to focus, and this is just a theme, 3 or 4 companies where I would say that from the management side, there is a clear-cut indication of creating shareholder value, significant shareholder value. Those are Crompton Consumer, Piramal Enterprise, Ratnakar Bank. These are 3 stocks where I feel that I've gone through their annual report and it's very clear, at least Piramal and Crompton, that they want to create significant shareholder value, and whatever it takes they'll do to create shareholder value in a most transparent manner. Plus businesses wise also, I would say that Crompton Consumer will definitely benefit from premiumization in fans,
right,
agro pumps, and various other categories, and ROE, ROCs are fantastic. So right. I would go with this 2 mid-cap stocks right now, slightly moving away from my auto component picks since last 1 year.
I'll just come back to these names. I just wanted to clarify about Exide. Is the call also about this insurance listing? What valuation do they get for the insurance subsidy, or you're looking purely at the battery business, the change of management over there, and that will lead to a better sales number?
No, so definitely insurance business will get a higher valuation. Right now, the expectation of the valuation of that business is around 2,500 crore. I think it should exceed that, given the recent momentum in the insurance companies. That will also increase, and plus, so if you remove that value, core business becomes very cheap at 15 times. For a business where 36% of revenue comes from replacement, at 15 times considering current market valuations of various other stocks, I think it is very cheap.
Right. Let's talk about Crompton Consumer then. You mentioned it. It's one of the new listings or one of the demerged entity. Not a lot of people know about it, but it is one of the highest ROE company in the durable space. Is that the attraction despite the PE valuation that it would be trading at?
Yeah, so PE wise, if I see, it is trading at around 30 times FY17, while ROEs are, last year's net worth was 228 crores, and they'll do something like 300 crores PAT. So ROE is going to be above 50% for sure, even if we add back this year's profits to the net worth. And I'm expecting some sort of good dividend payouts also. Plus, if you see, one is the fan category, which is growing, where premiumization is happening. Agri pumps is going to be a large market, because government is focusing so much on irrigation that agri pumps will have a very good times ahead. Plus, they are entering into various appliances also, and they have got good distribution network, which now they are leveraging. Plus, they have to penetrate into rural India also, because there they have very less penetration. So, a significant opportunity to grow, very high ROA business, and asset light business. See, you don't have to put up machineries for everything, right? They can just outsource and just brand it through Crompton. So, I think ROEs can significantly expand further. Plus very good dividend payouts, because there is no need of cash in the business. So I would say that it's a good and plus top management. If you see Shantanu Khosla, who has come from PNG, Mr. Sandeep Batra has come from Pidilite. So I think very credible names at the top management.
It was Crompton Consumer Business was always compared to Havells, and one of the key issue was the difference in the management. the sort of payout ratios that they have, the brand management that both these companies have. The point that you made about the new management largely addresses those concerns and still trading at a discount to Havells?
Yeah, I would say so. So, for example, Havells, in my view, should do a PAT of around 600 crores and market cap is around 25,000 crores. While Crompton can do a PAT of 300 crores and market cap is around 10,000 crores. So, definitely there is some discount in the valuation also. And as you rightly said, this top management coming from PNG and Pidilite will surely address that concern.
You expect, Crompton, when it was not demerged, there was always a buzz in the market that the Crompton management is looking to sell their consumer business, or there is a lot of interest as far as the consumer business is concerned. Do you look at that as a possible trigger going ahead? If that happens, it could significantly re-rate?
No, so right now I'm just focusing on current management, current strategy and opportunity to grow. And this is just a thematic thing because you get positive vibes when you read annual reports and when you go through what management has to say. And definitely that is the case in both Crompton Consumer and Piramal as of now.
Right. Let's talk about Piramal. Now, that's a very complicated company. It's not as simple as Crompton Consumer. What's the call over there? They have various businesses. Can you just tell us what is this? What's the call over here? What businesses are you looking at for
So
better
I think
growth?
Mr. Ajay Piramal has clearly stated that he wants to list the NBFC business in India and US information management business in US. I think both these things will unlock value because definitely, as you rightly said, right now company seems to be very complicated. But now if these two big parts get listed separately, then definitely there will be a lot of simplification and the investors who want to invest in that particular business will definitely buy those businesses and taking the overall value of the piece up.
As far as Mr. Piramal's comment is concerned, when we had spoken to him last in Jan-Feb at the sidelines of the Davos conference that happens, he told us very clearly that he is looking at creating NBFC separately plus the other businesses. Why would that unlock value? Because the NBFC numbers are reported separately, the US business numbers are reported separately. Why would that create value? Is it right now some investors don't want to get into X business but want to buy into Y?
Yes, 100%. That is the case. Investors don't like to buy the entire piece, right? For example, they have various other businesses like critical care, domestic business where they sell OTC products. They have custom synthesis, contract manufacturing business. Investors might not want to have that piece in their portfolio. They would just focus on, some people will buy just NBFC, some people will buy, and I think the US business will get a better valuation in US itself because it's a difficult business to value from Indian perspective because it's a data business. They are they are generating a lot of data and giving it to top pharma companies so that their R&D cost gets reduced. So I think it's a very difficult business to value in India. I think they'll list it in US itself, and I think that's what he has said.
Right. We had spoken to you earlier about the multiplex business. Now, they have done well in terms of whether you talk about PVR, whether you talk about Inox. And plus, there is an interesting news flow that one of the Asia's largest multiplex player would be wanting to buy stake into PVR. Would that change things? Are valuations now looking slightly higher, or it still continues to be a high growth business? That's why don't look at valuations on a daily basis?
Yeah, it's a structural business, I would say. And most importantly, the opportunity is huge and players are very limited. And so of course, I am not aware of this kind of acquisition or consolidation taking place in the sector, but if it happens, it is good for the sector. No doubt. It will take the valuations even further up.
Right. But multiplexes continue to be one of the overweight holding. I mean, just like autos, as you said, auto ancillary, as you said, they have also done pretty well.
Yes, so definitely there will be some valuation concerns and some consolidation time correction here and there, or 5-7% correction in the stock prices, but the theme remains very good.
Right. As far as some of the other sectors that we have not spoken about, pharma as a sector has done well. You've earlier always tracked pharma. Any names that you like within the pharma pack now?
So basically, see, pharma gave this kind of opportunity which right now IT is giving some months ago. And at that point of time, as you know, I was very bullish. For example, Lupin was available at below 1500 or Cipla was available below 500. So I think that made valuation very compelling as like it is in IT right now. But now definitely, see, one big thing is that US FDA thing is, I think, resolved, more or less. More or less all companies are trying to resolve it, and that correction was mainly due to that factor. So that is now going away. I think the major concern now is that US regulators want product prices to go down, and that it can be a structural point. So I have not formed my view on that particular aspect. So I would say that right now it is an equal weight.
Right, but US prices, US generic prices going down, that has always been a concern, right? It's been there for 4-5 years. What's going to happen to prices over there? How competition will come? But that can only be seen in hindsight.
Yeah, but I think we all know that in US pharma products prices are very, very aggressive. So let us see what happens, and let us see if this continues only till US election or it even extends itself further.
One of the ways to play the pharma pack has also been names like Dr. Lal or Fortis SRL, which will get listed soon. Are you looking at diagnostic business, and how would you rate that as a sector?
So I am very sorry, I have not done detailed work on them, so I will not be able to comment.
Right. Last when we spoke to you, you were very bullish about cement companies as well, and cement has done particularly well. But now, when I was just looking at valuations, I think the the EV per ton valuations is much higher than what one would use to set up a plant, or what one would use to go and acquire some big asset. Now it's looking difficult that returns from here may be back-ended.
Yeah, I completely agree that valuations have significantly stretched. So from here to make money on a short term or a 6-month basis is going to be difficult in my view.
Right. What is the sort of names that you would look at? As you said, that Fed rate hike could be a big event. What happens with some of the other central bankers? How would you look at which names would you look to buy, say if there is a knee-jerk reaction into the cement pack or the entire market?
So cement, definitely, see, Ultratech remains the best buy, no doubt, because they have capacity of 90 million tons. Right now they are selling just 55 million tons. There is a huge operating leverage. It's a pan-India play. Definitely, I would like to keep watch on Ultratech and Grasim, and would look to strongly recommend buying at a lower levels, say 5, 7 or 10% below current levels. I think that remains the best opportunity in cement, no doubt.